Have you ever wondered what it takes not just to make money, but to build wealth that lasts for generations? It's a question that countless people wrestle with, from young professionals to seasoned entrepreneurs. Achieving long-term financial stability isn't merely about hitting a big payday or striking gold on a single investment. True wealth, wealth that endures and creates ongoing security, is often the result of time-tested strategies, consistent discipline, and a desire to learn from real-life success stories. In today's discussion, we'll explore proven strategies for building lasting wealth. We'll examine both the numbers side, like investing and compound interest, and the human side, including mindset, habits, and real-life examples. By the end, you'll have a clearer vision of how to structure your finances for the long haul, and maybe even spark some fresh motivation to start or refine your journey toward lasting prosperity. When we say lasting wealth, what do we really mean? It's not just about having a lot of money right now. Lasting wealth implies financial security, sustainability, and the capacity to maintain or even grow your financial resources for decades, or pass it on to future generations. It's about creating a stable foundation that can weather economic downturns, personal crises, and still remain intact. Consider the famous story of the Rockefeller family. John D. Rockefeller became the world's richest individual in the late 1800s through Standard Oil. But what's notable is how his fortune was managed and grown even after his passing. His descendants benefited from sound estate planning, diversified investments, and philanthropic principles that stretched wealth across generations. If that's not a testament to lasting wealth, what is? But you don't need to be born into the Rockefeller family to achieve financial stability. The core principles of building lasting wealth, spending discipline, consistent saving, wise investing, are accessible to nearly everyone. The difference lies in how and when you start adopting these practices. One of the biggest hurdles in wealth building is short-term thinking. It's natural to look for quick fixes or immediate payoffs, especially when life feels unpredictable or expenses pile up. Yet almost every enduring fortune, from Warren Buffett's billions to your neighbor who retired comfortably at 50, has been built on the long-term mindset. Patience. Over impulsivity. Wealth doesn't appear overnight. Real growth happens slowly, often in the background, through the power of compounding and reinvested returns. Legendary investor Warren Buffett started investing as a teenager, and most of his wealth accrued after his 50s. Consistency over occasional big wins. It's tempting to chase the next big thing, whether it's a hot stock or a booming real estate market. But many fortunes fizzle because they rely on speculation. In contrast, consistent saving and investing month after month, year after year, tend to yield more stable long-term gains. Actionable tip. Write down your financial goals for the next 10, 20, and 30 years. Remind yourself daily that the small steps you take now are fuel for big results down the road. Before we talk about investments or big strategies, let's address something many people dread: budgeting. Think of a budget as the blueprint for your financial house. Without it, you're essentially guessing where your money goes each month. And guesswork is no way to build lasting wealth. Track every dollar. Even the small stuff like daily coffees or a streaming subscription adds up over time. Having a clear overview prevents money leaks. Automate key categories. Successful wealth builders often automate their savings and investment contributions, ensuring they pay themselves first. If money is automatically transferred to a savings or investment account, you're less likely to skip a month or spend that cash impulsively. Distinguish wants from needs. This is common advice, but it's the bedrock of healthy finances. Reducing frivolous expenses to free up more capital for investing can significantly accelerate your path to lasting wealth. Ronald Read was a janitor and gas station attendant who quietly amassed an $8 million fortune by meticulously saving and investing his modest income. He lived frugally, carefully tracked his spending, and regularly purchased dividend-paying stocks. Ronald's story proves that even if you're not pulling in a massive salary, disciplined budgeting and investing can build substantial wealth over a lifetime. When it comes to lasting wealth, few forces are as transformative as compound interest. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the underlying truth stands. Compounding can turn small sums into large nest eggs if given enough time and consistency. 1. Start early. The earlier you begin contributing to retirement plans, stock portfolios, or even a high-yield savings account, the more time compound interest has to work its magic. 2. Reinvest dividends. If you're investing in stocks or mutual funds, reinvesting dividends allows your returns to generate further returns. It's like planting a seed that grows into a tree, which then produces more seeds that can grow even more trees. 3. Stay consistent. Market fluctuations are normal. Those who stick with regular contributions during both bull and bear markets often reap the largest rewards in the long run. Quick example: if you invest $200 a month at an 8% annual return, you could end up with well over $300,000 after 30 years just from consistently putting away a few dollars each week. Scale that up, increase your monthly investment, or start earlier, and the numbers become even more impressive. Building lasting wealth typically involves investing in a range of assets. Let's touch on some proven avenues that have helped countless individuals secure financial stability. 1. Stocks and equities. Pros. Historically, the stock market has delivered average annual returns around 7 to 10%, adjusted for inflation, over the long run. It's highly liquid, and you can start with relatively small amounts. Cons. Volatility. Stock prices can swing dramatically in the short term, which can be emotionally challenging for some investors. Strategy. Focus on diversified funds or index funds if you're new to investing. Consider reinvesting dividends to harness the power of compounding. Second, real estate. Pros. Real estate is a tangible asset that can provide both rental income and property value appreciation. It also comes with tax benefits like depreciation write-offs. Cons. Requires more upfront capital and ongoing maintenance. Property values can stagnate or fall if purchased in less desirable areas. Strategy. Start with a primary residence if you can afford it, then explore rental properties or real estate investment trusts, REITs, to diversify risk. 3. Bonds. Pros. Generally less volatile than stocks, providing a more stable income through interest payments. Cons. Lower potential returns compared to equities, especially in a low-interest environment. Strategy. Consider bonds for the fixed income portion of your portfolio. They offer stability, which can help balance out risk from stocks. 4th, business ventures. Pros. Owning or investing in a business can produce significant returns if it grows. You have more control over strategy, branding, and decision-making. Cons. High risk if the business model isn't validated or if you lack managerial expertise. Strategy. If entrepreneurship excites you, start lean. Test your market, minimize overhead, and reinvest profits into growth rather than inflating your lifestyle. Real-life example. Sam Walton, the founder of Walmart, started with a single store in Arkansas. By focusing on everyday low prices and reinvesting profits to open more stores, he built one of the largest retail empires in the world. His wealth creation was grounded in a simple principle: offer value, reinvest earnings, and grow slowly but steadily. You've heard the phrase countless times. Don't put all your eggs in one basket. It's classic advice, because it's true. Relying too heavily on a single investment or sector can derail your finances if that asset collapses. Diversification means spreading your money across various avenues: stocks, bonds, real estate, possibly even commodities or alternative investments like precious metals. Why is this so critical for lasting wealth? Because economic cycles are unpredictable. Some assets perform well during certain times and poorly during others. By diversifying, you're more likely to smooth out the peaks and valleys. You might not see the same explosive growth you'd get by betting everything on one golden opportunity, but you'll also avoid catastrophic losses that can wipe out years of progress. Actionable tip: look at your existing portfolio or savings. Are you overly reliant on one sector, like tech stocks, or do you only have money in real estate? Investigate ways to diversify. This might mean adding different funds in a retirement account or considering a rental property if you're mostly in equities. A balanced approach fosters stability over the long haul. Building lasting wealth is not a set-it-and-forget-it activity. It's crucial to continually upgrade your financial knowledge. That doesn't mean you need a PhD in economics. But as the world changes, new technologies emerge, markets shift, and regulations evolve, you'll want to keep learning to make informed decisions. Read widely, from classic finance books like The Richest Man in Babylon to modern investment blogs and podcasts. Attend workshops or webinars. Many local communities host free or low-cost seminars on real estate investing, personal finance, or entrepreneurship. Seek mentors. Learn from those who've already achieved what you aspire to. Their real-world experience can help you avoid common pitfalls. Case in point. Billionaire Bill Gates is famously known for his voracious reading habits, devouring around 50 books a year. Even after co-founding Microsoft and accumulating enormous wealth, he continues to learn about technology, healthcare, finance, and global issues. Gates' thirst for knowledge shows that education doesn't end once you reach a certain bank balance. If anything, it becomes more crucial to maintain and grow that wealth. Lasting wealth isn't only about how much money you bring in. It's also about how much you keep. This is where the concept of the wealth gap, the difference between your income and your expenses, comes into play. The bigger that gap, the more resources you have to invest and grow over time. Increase your income. This can happen through career advancements, side hustles, or passive income streams like rental properties or dividends. When you generate more money, you have more to save and invest. Reduce unnecessary expenses. High-end consumerism can quickly erode your gap if you're not careful. Whether it's impulsive online shopping or an inflated mortgage, controlling expenses is paramount to keeping that gap wide. Mindful lifestyle upgrades. Lifestyle inflation is a real threat. When your income rises, it's natural to reward yourself with a nicer car or more expensive hobbies. But be cautious. Every dollar spent on lifestyle is a dollar not working for you in investments. Real-life inspiration. The late David Bach, a personal finance author, coined the term latte factor to illustrate how small, habitual purchases, like daily lattes, can add up to significant sums over time. He argued that by redirecting even $5 to $10 a day into investments, you could accumulate a surprising amount of wealth over decades. Financial success isn't just about numbers. It also hinges on mindset. Various psychological barriers can derail your progress. 1. Fear and doubt. You might worry about losing money or facing a market crash. Healthy caution is good, but paralyzing fear keeps you from taking calculated risks that lead to growth. 2. Imposter syndrome. Some people feel they're not the type to be wealthy, or that they don't deserve success. If you've worked diligently and followed smart strategies, you do deserve it. 3. Greed and overconfidence. Conversely, chasing unrealistic gains like betting your life savings on a single cryptocurrency or penny stock can wreak havoc. Slow and steady often wins the race. Strategy to overcome: engage in regular self-reflection, and if necessary, seek professional or personal support. Join groups or forums dedicated to financial literacy. Hearing stories from others who face similar fears and overcame them can motivate you to keep going. Finally, if your goal is to ensure that your wealth truly lasts beyond your own lifetime, you'll need a legacy plan. This involves wills and trusts. Outline how your assets will be distributed, so your loved ones don't have to deal with legal chaos if you pass away. Financial education for heirs. Teach your children or other beneficiaries the principles of wealth building and responsible money management. Philanthropy. Many wealthy individuals give back to causes they care about. This can continue through donor-advised funds or charitable trusts. It's a way to do good in the world while also cementing a lasting legacy. Real-life example: Oprah Winfrey, who rose from humble beginnings to become a billionaire media mogul, invests in education for girls through her Leadership Academy in South Africa, among other philanthropic endeavors. This long-term perspective ensures her impact, and in a way, her wealth extends well beyond her own lifespan. Building lasting wealth is an ongoing journey, not a one-time event. It requires a blend of the right mindset, disciplined habits, and a willingness to continuously learn and adapt. From setting a proper budget to leveraging the power of compound interest, from diversifying investments to creating a thoughtful legacy plan, each step acts like a puzzle piece that contributes to a bigger, more secure financial picture. Remember that anyone can adopt these principles regardless of their starting point. You don't need $1 million salary or a trust fund inheritance. You need intentional action, patience, and a strategic approach. Begin by examining your financial habits, deciding where you can make small but meaningful changes, and staying committed for the long haul. Hopefully, today's exploration of proven wealth-building strategies has given you fresh ideas and renewed motivation. If you found this helpful, be sure to like, share, and subscribe for more insights on personal finance and wealth creation. Now it's your turn. Take the next step. Embrace the mindset of growth and start laying the foundations of lasting wealth. Your future self, and maybe even future generations, will thank you for it.